Well, hello and welcome back to Principles of Accounting 1. I am still your host, Dr. B. We made it to the last week of this 8-week course, which means we made it to the final exam stage. So today we're going to talk about investments and the statement of cash flows in two separate recordings. And on that second recording, we'll also talk about the final exam in a little bit more detail. To quickly highlight where we are in the classroom, we made it all the way down to Module 4, and we're in Week 8. This is the final week of this course. This is the last day we'll have lecture for this course. So we're going to talk briefly about investments, which is Chapter 15, and then we'll talk about the statement of cash flows, which is Chapter 16, and then the final exam will also be covered today. So let's go ahead and start our conversation on investments, and then we will roll on through. As always, feel free to unmute your mic if you have a question or if you have a comment, and I'll try my best to make this one somewhat entertaining because investments has an impact on all of us at some point in our lives, and I want to talk about investment from the perspective of business because those of you who are going into business, you're starting your own business, whatever, you're going to need to do some investing. That's how it works, right? You got to invest to get started. So when you hear the word investment, think we're investing capital into something. Right? We're investing into either a short-term or long-term investment. An investment simply means I'm investing into an asset that I am going to either hold for sale in the future, or I am looking to gain on that asset investment at some point in the future, whether it be short-term or long-term. As you know, the word short-term means less than 1 year. Less than 1 year. Short-term, less than 1 year. Long-term, greater than 1 year. So the same concept applies with investing. Short-term investments, that is an investment that we plan to sell within 1 year. Long-term investments, those are investments greater than 1 year. So a short-term investment example might be a share of stock, a bond, something along those lines. Maybe inventory to some degree. Those are all short-term investments, yeah? I plan to sell those things within 1 year. That's what a short-term investment is. A long-term investment is greater than 1 year. So an example of that would be the purchase of property, plant, and equipment. And in some cases, I might sell those things, plan to sell those investments in the future. For example, with a long-term investment strategy, sometimes manufacturers will purchase the land around them with the notion that they will either use that land to expand their business, or they will simply hold on to it and then sell it later on. Okay. Another example of a business that does it is Disney. The Disney Corporation, who has their theme park in Florida, bought a lot of land around the theme park, and without an intention to develop that land. The company bought a lot of land around the theme park without intention to buy the land, without intention to develop the land. And so what Disney's doing there is they have a long-term investment in the property, and they'll either use that property to expand the business, or they'll use it and sell, or they'll just hold on to it and sell it later. And that is a very common business practice. And so we'll talk about these kinds of examples in a little bit more detail. So when we talk about investments, we want to talk about the differences between a debt investment and an equity security type of investment. And we look at these in both the short term and the long term. A debt investment is like issuing a bond. That's a debt investment. Issuing shares of stock, that's an equity security. A debt investment is like issuing a bond. Equity security is like issuing stock. A debt investment might also be taking out a mortgage for a property, for a building. A debt investment might be like taking out a mortgage for a building or a property. And as you know, that's a long-term debt investment. A short-term debt investment might be using a loan to purchase a piece of machinery. That would be a short-term debt investment, assuming that the loan is repaid within the 12 months or less. And so we'll go through a couple more examples. Investing, of course, can be done at either the business level or the personal level. But for this course and for these purposes, we're going to talk about it from the company's perspective. There's a couple of reasons why companies invest. One of those, of course, is to utilize their extra cash on hand to produce higher income. What we mean by that is sometimes a company will invest in assets and sell them later, and they'll use their extra cash to do that. In the meanwhile, the company might be generating additional income through interest. Interest income is generated by companies when the company invests in an asset and holds it for a period of time. So companies invest their extra cash to produce what we call investment income or interest income. So that's one reason. Another reason would be some companies set up to produce income from their investments. What I mean by that is a company will invest in property, plant, or equipment and then use that property, plant, or equipment to produce goods and services that ultimately generate income. That's true for most businesses, yes. And the third reason why a company might invest in something is for strategic reasons. Earlier I gave the example of Disney purchased a lot of land in Central Florida around the theme park. This is a strategic move. The reason for this strategic move is the theme park can use that land for expansion, or they can use that land, hold on to it in the hopes that the value rises, and then sell that land in the future. Therefore, the purchase of the land around the theme park is a strategic investment. Here are a couple of examples of companies that have investments and what their investment portfolios look like. We can see that these four companies in particular have a combination of both short-term and long-term investments. And we express these investments as a percentage of their total assets. As you know, investments are a form of an asset because the extra cash that the companies use to purchase investments are held by the company and are typically portions of investment. What I mean by that is an asset like inventory, property, plant, and equipment, to some degree, bonds that are available for sale, stocks are available for sale. These are all assets. They're assets to the company because they can be converted into cash and utilized. So we express investments as an asset. And what we do is we take the total investments for short-term and long-term and divide them by total assets. As you know, total assets are all the company's assets added up together. Cash, inventory, accounts receivable, property, plant, and equipment, all those together equal total assets. And we can see total assets on the balance sheet. So we take the short-term investments divided by total assets, long-term investments divided by total assets in order to get these percentages. Okay? So, for example, we can see Coca-Cola has 9% of all of their total assets tied up in short-term investments and 18% tied up in long-term investments. We can guess as to what those investments are. Short-term investments that Coca-Cola may have made are stocks in other companies, maybe inventory, maybe it might be something else. We don't know. They're short-term, though. The long-term investments could be land, properties. Those could be long-term investments. And we can see how it breaks down for Starbucks, Pfizer, Microsoft. The Microsoft one is interesting. We see that they have 52% of their total assets tied up in short-term investments. These short-term investments are typically stock positions that they have in other companies. So Microsoft will typically do that to other software companies. We've seen this, right? Recently, Microsoft purchased a large portion of a couple of game manufacturers. And so that was a large investment they made recently. They've also done this with LinkedIn. Microsoft owns LinkedIn. They also own several other large software and hardware companies as well. So those could be a part of their short-term investments. But short-term investments are typically securities that management intends to convert into cash within 1 year. That's why I call it short-term. Within 1 year is the key word here. Companies can sell these short-term investments and convert them into cash quickly. And that's typically why companies will purchase other companies' stocks, or they will purchase their bonds or whatever, right? It's the short-term investment can be quickly converted into cash later on, which is why companies oftentimes will invest in the short term in other companies. And the reasons for this, again, could be that they want to generate additional income from the interest, or they want to strategically position themselves in the future. Long-term investments are greater than 1 year, and they're kind of difficult to convert into cash. And the reason for that is It's difficult to sell a piece of land or a building or machinery quickly. It's very difficult to do it quickly. It usually takes quite a bit of time, right? And it's not easy to convert a building into cash right away. It's just not. So that's why we consider property, plant, and equipment to be long-term investments for a company. They're not intended to be converted into cash in the short term. In other words, most companies don't buy a building and then for the purpose of quickly converting it into cash later on. That's not a strategic move for the most part, right? The long-term investments by companies are reported under non-current assets or long-term assets on the balance sheet. And it's typically in its own category. So when you're looking at the balance sheet, you're going to see an area that says non-current assets or long-term assets. And they'll all be listed out what those investments are. You know, property, plant, equipment, and then whatever else. Now, earlier I had mentioned that some companies will invest in either debt or equity. Debt securities is typically where one company will purchase the bonds of another company. That is a form of a debt security because the one company has to pay the bond back, right? It's kind of like a short-term loan. Equity securities are typically stocks. Equity securities is where one company will purchase another company's stock. The reason why this commonly happens is for a few reasons. One is the company might be planning a hostile takeover of the other company. So you'll see one company purchase another company's stock. An example of this is when Starbucks purchased the majority of shares of Peet's Coffee. So what happened is Peet's Coffee was publicly traded, so was Starbucks, and Starbucks corporate decided, hey, let's buy Peet's Coffee, and one way to do that is to buy the majority of their available shares. So when Starbucks became the largest shareholder of Peet's Coffee, they hostilely took over the company, right? Because remember, the shareholders are the ones that are actually in charge of a publicly traded company, not the board of directors. The shareholders tells the board of directors what to do by voting, right? We talked about this some time ago, but it's important to understand that concept. So debt securities against bonds, short-term loans, also known as notes, and certificate of deposits. Those are debt securities. Equity securities, again, are shares of stock, most typically. For reporting, companies report both their debt and equity investments, and they do this through a couple of different ways. One, most notably, is called an 8K report, and these are to reflect changes in shares of stock ownership. So the equity part is through the 8K for publicly traded companies. The debt and equity are both reported on the company's 10K report, which is their annual report. These are both typically reported in the notes of the company. The debt and equity security investments are also found on the balance sheet, typically under assets, right? The intent is to hold the security for short or long term. So a bond security is typically short term. It could be long term if it's greater than a year. And the same with the stocks. If the intent is to hold on to the stock for greater than 1 year, then it's long term. And of course, one of the biggest reasons why one company might invest into another is to acquire that company, and they do that through the shares of ownership, and it's expressed as a percentage of ownership of another company. For debt investments like bonds, they're typically held to maturity, meaning that one company holds on to the bond until it matures, when that bond has to be repaid back. Yeah. The company holding the bond might trade the bond that they have, or they might hold it available for sale. For equity investments like stocks, owning a percentage of the stock, the total stock for another company, indicates whether it's insignificant, significant, or controlling. A controlling equity is where one company has the majority of the shares available in another company. And when you have control, it's said that you have the majority ownership of that company. Significant influence simply means that you have a large share of ownership, but you don't have the majority share of ownership. Then insignificant influence means you have a small percentage of ownership in the company, but your vote typically is not going to sway any kind of real influence in the management. So as you know, anytime that there is the purchase of an investment, we need to record that purchase. And so here's an example of this. One company purchased a bond as a debt investment. So if the debt investment is an asset account because the bond is owed back to the company that's purchasing it, right? So debt investment is an asset account. So we debit debt investment and we credit cash. And this transaction represents the purchase of a bond. So in this example, it's for $30,000, 7% interest, and it's 2 years. So it's long term. Over time, the company will receive their interest. If 7%, the face value is $30,000. The company receives this interest payment twice per year. So in order to calculate this, we take the face value, $30,000, times the interest rate, 7%, times 0.5, which represents the biannual payment. 6 over 12, that's the same as saying 0.5. 6 over 12 is the same as 0.5, yeah? So we debit cash, $1,050, and we credit interest revenue, $1,050. The $1,050 represents the interest that the company is receiving from holding the bond in another company. When the bond matures, the company will receive this face value back. So we debit cash, $30,000, and we credit debt investment, $30,000. Again, these are both asset accounts. Cash and debt investments are asset accounts. So we're only affecting the one side of the balance, one side of the accounting state equation. Sometimes a company will purchase a bond and then trade that bond. They'll sell that bond on the bond exchange. Debt investments are commonly traded on bond exchanges. They're managed to receive a profit. They're recognized as current assets on the balance sheet. Reported at their fair value. And if there's a gain or a loss from the change in the fair value, it's reported on the income statement. This shouldn't be new to you because we did talk about this last week. Here's an example of a bond being traded on the open market. In this example, the bond had a total cost of $11,500. Its fair value is $13,000. So there's going to be a difference, of course, that we need to recognize. And in recognizing that difference, we debit fair value adjustment from trading, and we credit the unrealized gain, which is a form of income. And on the bottom here is what it looks like on your balance sheet. Here's another example. The company is selling trading securities that cost $100 for $120 each. That means we're going to get a $20 gain on the sale of our investment. The gain is reported as other revenue and gains on this income statement. So we debit cash $120 because we're receiving cash. We credit debt investments trading $100. That's the cost, right? And we credit the gain on sale of debt investments $20 because we're gaining on the sale of our investment. Asia, question. I'm sorry, Asia, I couldn't hear you. I'm sorry, for some reason I still can't hear you. I need to adjust your mic. I'm sorry, for some reason there's no audio coming out. Can anyone else hear her?
No.
Okay. Asia, you might need to disconnect and reconnect. Sorry about that. It's, technology. Sometimes it just don't want to work right. No, sorry, I still can't hear you.
Okay.
Wait, I got you now.
You can hear me now?
I can hear you now. Okay, you're there.
Okay, so the question is kind of not directly on topic, but what I'm asking is like, so you know how these companies are selling debt bonds, right?
Yeah.
Okay, so say like I have a debt and I haven't paid it, it grew out of the period, so they sold it to a company.
Right.
But 9 times out of 10, I'm not going to pay their full debt to that company. That company is going to settle.
Right.
So what I'm asking is, how are these companies who are selling debt making a profit when the company who's buying the debt is going to receive less money, from the who owes?
That's a great question. Yeah, I know exactly where you're going with that question. So here's how this works. I'm going to give you an example. Okay, let's say I went to Macy's. Oh, my favorite store, Macy's. Let's say I went to Macy's and I bought $1,000 worth of new clothing at Macy's, and I used my Macy's store card. Okay, used my Macy's store card, bought $1,000 worth of clothing. And let's say, 30 days later, I get my statement for my store card, and it says I owe, whatever, $100, whatever, for the month. Let's say I decide not to pay them. Okay, so a month goes by, they add on some interest. A month goes by, they send a second notice out, oh, you're late. So they hit me with a late fee and more interest. Another month goes by, they hit me with another late fee, some more interest, and a third notice. Another month goes by, they hit me with another late fee, some more interest, and another notice. And then eventually, they'll just simply sell what I owe them to another company, a debt collection agency, typically. Now, here's how it works. And this will probably hopefully answer your question, Asia. So here's how it works. By now, I didn't owe Macy's just the $1,000 in the purchases. I owed them $1,000 plus all of the late fees plus all of the interest. So we're talking probably $1,500 by the time they got around to selling the debt to a collection agency. Now, what Macy's is going to do is they'll sell that debt to the collection agency at a discount. So instead of Macy's selling the debt to the collection agency for $1,000, which is what I owed Macy's, Macy's will sell it to the debt collection agency for about $750. So Macy's takes a loss of $250. And Macy's will write that loss off as a bad debt expense at the end of the year. Now, the collection agency, on the other hand, purchased the debt from Macy's for $750. The collection agency will go after me for the $1,000 plus all of the interest, plus all the fees. Okay? So, debt collection agency, if they're successful in collecting the $1,000 plus the fees plus the interest, they of course made a profit collecting from me because I didn't pay Macy's. Macy's sold the debt at a reduced amount to the debt collection agency. The debt collection agency comes after me for the full amount, right? So if the debt collection agency is successful, that would generate a profit, right? Anything over the $750 is a profit for the debt collection agency. If they're unsuccessful, meaning I'm not even going to pay the debt collection agency, then that agency will write off that $750 as a bad debt expense. But that's how it works. That's how this kind of thing works, right? Is that?
Yes. So trading securities are in a different category from those type of debt.
Correct. That's correct. Yeah.
They can be sold for a higher price.
Yeah, exactly. And that's typically how it works. Is when there's debt investing going on, that typically means that one company lent the other company a loan in the form of a bond. Okay, and so what that means is, the first transaction is I give the money to the company that is wanting the bond, right? So debt investment, the bond value, cash going out, that cash is being paid to the company that I bonded with. Yeah, so I'm holding the bond paper. The company I gave the money to is going to pay me back, the debt investor, that amount plus all the interest, right? And so that's the kind of debt investment we're talking about here. So instead of like a bank just lending the money to the company, it's one company lending the company money, in the form of a bond. Yeah. The debt investment that you're talking about, Asia, is similar. It's very similar because it's still technically debt investment. That's what debt collecting companies do, is they're buying bad debt from other companies in the pursuit that they're going to go after the original debtor, the person that owes the money. They're going to go after that original person for not only the principal balance, but also any kind of interest and fees. But it works the same way.
Okay, thanks. Yeah, that helped me clarify and separate, the two categories. So thank
Excellent.
you.
Very cool. Great. Good. Very good question. Okay. Now, sometimes, actually most of the time, a debt will be held till its maturity. Meaning, one company that held that bond for the 2 years, they're going to hold it for the whole 2 years. Okay. That's what it means to hold it to maturity. The word maturity means the due date, when the whole thing is due. Yeah, that's what the word maturity means. The bond has matured. That means that I need to pay back the face value of the bond. Yep. So in most cases, the bond or the debt will be held to maturity. It's reported as a current asset if it's within 1 year, right? If there's a larger balance, it's a non-current investment. If it's greater than 1 year, yep. And you'll see the letters HTM. Call these HTM securities, held to maturity securities, HTM. And these are amortized, reported and amortized at cost. And there's no fair value adjustment when a debt is held to maturity. Available for sale. In some cases, I might hold on to a bond and then sell that bond to another company. I can issue a bond, hold on to that bond, and then sell that same bond to another company. Some companies do this on purpose. The idea of generating additional revenue or additional interest. We call these types of sales debt investment available for sale. So I hold on to the bond with the intention of selling that bond in the near future. Call those available for sale. These are short-term investments that we intend to sell within 1 year. Okay. Sometimes I might hold on to it for longer than 1 year, in which case it becomes long-term. We recognize these at the fair value, meaning we find out what the market price is for these bonds, and we list those at the market price or the fair value. And if there's an unrealized gain or loss, we report that as other income. Yep. So here's an example of recording the fair value. Remember, the fair value is like the market price. And we adjust it up or down based off of what's happening with the market. So it's our cost minus the fair value gives us the unrealized gain or loss. Cost minus fair value equals unrealized gain or loss. Okay. If the fair value is greater than the cost, then it's a gain. If the cost is greater than the fair value, then it's a loss. Yep. And this is an example of this type of entry debit fair value adjustment, and we credit unrealized gain or loss, depending on what it is. This is what it would look like on your balance sheet. Now, just like anything else, especially if it's long-term or if it was purchased like mid-year or whatever, sometimes that security or that debt will extend into the next year. And we need to make an adjusting entry at the end of the year to recognize that difference. Remember the matching principle. According to the matching principle, we recognize revenue and their expenses in the time that they're incurred for that particular year, right? So at the end of the year, we make an adjusting entry to recognize the unrealized gain based off the adjustment, right? And this is an example of this. Now, earlier when we talked about stocks, I had mentioned that one company owns majority of the shares of another company that is said to have controlling stock. If I own more than 50% of any company's stock, I am the controlling member. What I mean by that is, when it comes time to vote as a controlling member, meaning I own more than 50% of all the shares of the company, when it comes time to vote for my shares, I can dictate what happens for the board of directors. I can tell the board of directors what to do because I am the controlling member. I own more than 50% of the company's shares. Right? That's controlling. You might have significant influence in a company. And the way you have significant influence over the board of directors is you own between 20 and 50% of all the shares of the company's stock. It's called a significant influence. And with your significant influence, you can influence the board of directors to do what you want them to do. But most of you are probably like me, and I'm an insignificant influence. I own between 0 and 20% of the company's stock. Okay, I can't tell the board of directors what to do if I only got 20% of the shares of stock. Okay, it don't work that way. I'm an insignificant influence. Yeah, I got some voting power. It ain't gonna go that far. That's insignificant influence. Now, with stock investments, they work very similar to bonds, right? Let's say we're going to invest in another company's by buying a bunch of shares of another company, right? So I would debit stock investments and credit cash. This represents me purchasing shares of stock in another company. So I debit stock investments $7,000 for 100 shares of stock. Credit cash $7,000. I'm paying the other company $7,000 in exchange for 100 shares of that company. Now, that company that I just purchased the 700 shares from, they happen to pay a dividend for the shares, right? For the shareholders. And so, once a year, I receive $10 check in the mail from that company as a form of dividend. So I debit cash $10. I got $10 based off my investment. And I credit dividend revenue $10, okay, to recognize the revenue I got from owning shares of stock in that one company. Now, over time, the value of the stock goes up and down. Yeah, that's what stocks do. They go up, they go down. Okay, what goes up must come down. Sometimes they go up, sometimes they go down. And so I need to record any gain or loss based on the adjustment of the fair value. So I bought 7,000 shares of stock. At the end of the year, the value of that stock went up. Went up to 9,000 for all the 700 shares I own. So that's a $2,000 gain, right? I bought it at 7,000 for 700 shares. Those 700 shares, the value went up by the end of the year. Now I have $9,000 worth of stock. Still the original 700 shares. It's just the value of each share went up a little bit. So I need to recognize that $2,000 gain. And the way I do that is I debit fair value adjustment, 2,000. Credit unrealized gain, 2,000. And this is what it looks like on your balance sheet. Now, I might decide, to sell some shares. I'm doing pretty well. I got 700 shares. I might sell like 5 shares of it, 10 shares of it, whatever. So okay, nothing wrong with doing that. So I sell a couple shares of stock. I debit cash, $800, because I got $800 coming in. It cost me $500 when I first bought those shares. So I take the sale price that I sold them at minus the cost. That will give me the gain. Yeah. Remember, I bought 700 shares of stock at $7,000. If I sell a couple of shares, how many I sold here? A few, obviously. Remember, it went up to 9,000 at the end of the year. Now here I am the next year, and I'm selling a couple shares. So I debit cash $800 because I sold a couple shares for $800. It cost me $500 originally for those shares that I had sold. So I credit stock investments $500 to recognize that I had sold those shares, right? And then I credit gain on the sale of stock investments, $300. Sale price minus cost gives us the gain. Now, what we just talked about was for insignificant influence. It's pretty typical, the majority of people who own shares of stock, it's insignificant influence. Now let's talk about significant influence, which is 20 to 50% of shares outstanding for the whole company. So let's say we own 30% of another company. I'm buying 30% of another company. So 3,000 shares is what I'm going to buy, common stock, for a total cost of $70,000. So I debit equity investments, $70,000, and I credit cash, $70,000, to show the purchase of the 3,000 shares. Now, at the end of the year, I need to recognize earnings from those shares of stock that I own. So I own 30% of the company. This means that my company is entitled to recognize 30% of that company's earnings. I own 30% of the company, therefore I can recognize 30% of that company's earnings. Okay? And what that shows is I'm a 30% owner of the company, right? I debit equity investments 6,000, and I credit earnings from equity investments 6,000. How do we get 6,000, you might be asking? The company reported revenue of $20,000 for the year. I own 30% of it. So 20,000 times 30%, or 0.3, equals $6,000. So the company that I invested in pays out a dividend. I recognize that dividend. I debit cash and I credit equity investments. In this example, I received $3,000 in dividends. Now, how did we determine $3,000? Take the cash dividend times the percentage of ownership, in this example, 30%. So 10,000 times 0.3 equals $3,000. For reporting purposes, I also have to show the book value of the investment. And this is the cost plus earnings per share minus dividends. It gives me my book value. The cost plus earnings per share of earnings, minus dividends. Gives me the book value. When we decide to sell our investment, our stock, we recognize the sale price. In this example, we sold it for $80,000. Sweet. The value of my stock had changed, right? I originally bought it at $70,000 or whatever, or $80,000. Got my $80,000 back. I sold 3,000 shares for $80,000. So I debit cash $80,000. I credit equity investment for $73,000. That's the book value, right? That's the book value. The difference is the gain. $80,000 cash minus $73,000 book value gives me a gain of $7,000. So a credit gain of sale stock, $7,000. Let's take a look at controlling influence. Controlling influence is when you own 50% or more of the company based off of their shares, right? So on the consolidated financial statements, you'll see this percentage of ownership. Technically, you would be the parent company. If your company owned 50% or more of another company, you're the parent company at that point. This is a nice summary of how equity investments are displayed. Your income statement, if you're the parent company, your income statement will be titled comprehensive income because you won't just report your income for your company, you'll also be reporting the income based off of the controlling shares of the other company that you have 50% or more in. Net income plus other comprehensive income equals comprehensive income. There are a couple of ratios, of course, that can help us to analyze our investments. One of these is called the return on total assets. And we find return on total assets by taking the profit margin times total asset turnover. It gets a little bit more complex than this. So profit margin, we take net income divided by net sales, so net revenue. Income divided by net sales times total asset turnover, which is net sales divided by average total assets. Average total assets is the beginning balance assets plus the ending balance assets divided by 2. That gives you average total assets. And this is an example of how those calculations look. Profit margin times total asset turnover equals return on total assets. Any comments, questions, or concerns on investing? Investments. Good so far?
Yeah, this wasn't that complex. It was pretty smooth.
Good. Yeah, I'm happy to hear that. That makes me feel good. Okay, let me go ahead and stop this part of the recording, and then we'll roll into statement of cash flows. Hold on just a sec.